In this video, I'm going to be discussing my Forex trading strategy, which involves dollar cost averaging and mean reversion. Here's a proof of concept of an account that I've traded with this style since September of last year up till now. And if we just talk a bit about the highlights of this strategy, we're going to be talking about a very simplified version of buy low, sell high. I know, the age-old simple trading expression. This is what you learn on day one. You want to buy low and sell high in trading. But I'll tell you about how this can, in this video, relate very specifically to currencies so effectively, and why this particular trading strategy that I'm about to show you has a very high win rate. And one of my favorite things about this strategy is that it has very little focus on entry timing. Now again, how many times have you sat in a particular chart setup that you're looking at, and you think, for example, that you overall think the market's going to go down, but the timing is tricky, and so you put a tight stop and you get stopped out, only to watch eventually your original direction, you thought it was going to go down, it actually ends up following through to the downside. But because the timing was so tricky, you ended up stopping out before capturing the move. Well, what's cool about this style of trading that I'm about to just show you is that timing is not of the essence. In many trading strategies, it's all about timing, it's all about entries, it's all about getting the perfect, tight stop loss entry. Whereas in this strategy, one of the biggest pros, and there are cons, of course, that we'll discuss, but one of the biggest pros would be that the focus is far less on timing the entry and much more on general direction / fundamentals. So this approach that I'm about to discuss with you is a heavily focused, slow and steady trading strategy. And when it's done correctly, it should be boring. How many times have you heard that good trading should be boring? Well, I'm going to show you exactly what I mean by that. And truthfully, it can get boring with this strategy. And that, to me, is a positive or a green flag rather than a red flag. Just a warning before we jump into some of the credentials of this trading strategy. I'm going to get very technical here. I'm not going to give you any sort of paywall or pay for my course in order to see the strategy. I'm going to show you all of it in depth here in this video. But I just wanted to warn you that this is what I do and is not necessarily right for everyone, and that this is not financial advice. I'm not here to tell you exactly how you're going to make a bajillion dollars in the markets, and I wish I could. I would tell you if I could. It's quite hard to make money in the markets. So with that out of the way, let's talk about the strategy. So let's first of all, this is going to be overly simplified here in this first segment. Step one is we're going to identify a currency pair where the macro fundamentals, which we'll talk about in a second, so don't let that scare you, strongly favor one currency over the other. Let's say we're looking at the euro against the US dollar. We want to look for scenarios in which one currency looks very strong and one looks very weak. And we want to trade that strength differential. On a fundamental basis, I will show you the high-level views of how I do that in just a second. So step two is we're going to look for price action to become or to disagree with the fundamentals that we just established. So let's say we think the euro looks really weak and we think the dollar looks really strong. We're going to look for price to actually be disagreeing with that. The euro moving higher against the dollar, giving us a potential overextended level. I'll show you on a technical basis what I mean by that shortly. Number three, we're going to buy or sell in favor of the macro fundamentals in very small quantities. And I'll show you why. The reason is because we are not going to be using a stop loss with this trading strategy, which is a red flag for many, but I'll tell you about how there are ways that I personally manage risk. A stop loss is not the only way to manage risk, contrary to popular belief. So here's the strategy, part 4. We want to map out a campaign of possible entry points ahead. Remember our example that I just shared with you, like let's say we think that the overall market is going to move lower, right? Instead of going all in short right here, what we're going to instead do is look for very small points to add to a short position, with the ultimate idea being that we're going to target a move lower, but we're not so worried about getting the perfect timing. So the idea is basically we're going to add to a trade going against us by dollar cost averaging. Now, each time you add to a short position here, what you're doing is you're bringing your cost basis higher, averaging up in this case, right? So you can dollar cost down or you can dollar cost up if you are short on a particular trade. And so The concept here with no stop loss, again, don't let that scare you too much, because yes, having a no stop loss trading strategy can be devastating if you are, an idiot with your position sizing. But if you are really, really defensive and use other strategies to manage risk, a stop loss is just a way to close out a trade. There are many decision points you can make to close out trades and to manage risk. It doesn't necessarily need to be a stop order in the market in order to get you out. There are many other ways to manage risk and exit a position that's not going correctly. So, for example, we'll talk about a max drawdown strategy instead. That can also be used. And I just want to reemphasize what I just discussed about position sizing. Tiny position sizing and other methods of risk management are imperative. They are massively important to this trading strategy, because we're not just going to go all in short and just massively martingale our way into a blown account. That is not what this trading strategy is all about. And I'm going to give you more context about risk management as we get further into the video. This is, again, the overly simplified part of the video. In terms of targets, on a technical basis, we're going to use some sort of fair value metric, oftentimes a moving average or a key level of market structure, to target where we want to get out of the trade. Where are we going to lock in profits? I'll discuss that more as we get into the technical side of things. And the order of importance here, risk management is number one. This is the most important component. Fundamental analysis or directional bias is number two. And technicals are important, but they are the least important of the three. We're not so worried about timing. We're not so worried about getting the perfect entry. We are worried about the general direction far more and managing our risk in case we're wrong. If you know my channel well, then you know that I don't just trade currencies. I trade indices, commodities, stocks, and options. I trade a bit of everything. But the nature of currencies is very unique. And this is why my strategy in FX is different than how I trade indices and gold. Stocks drift upwards over time. The VIX, or volatility, drifts downwards over time, but currencies are unbound. Over the long term, they tend to mean revert. They tend to go nowhere. Let's look at some charts. So here's the NASDAQ. You can see this goes back to 2004. It overall has moved higher and continues to move higher, and it should move higher. Assets over time rise. Now, they don't rise every single day, every single week, every single month, or every single year. But over the long term, they drift slowly higher. Same thing with gold. You can see gold, while it may have, very long stretches of bear market periods, over the super, super long term, it gradually, slowly goes up. But the same cannot be said for currencies. Here's the euro against the US dollar on a weekly chart. This is a weekly chart, guys. Multiple years of data. And all this currency pair is doing is on a big picture, moving up, having trends to the upside, trending down, trending up, trending down, trending up, trending down, trending up. It moves sideways. Now, is that a guarantee that it's always going to move sideways? No, just like it's not a guarantee that the stock market's always going to go up. It could go down for 10, 20 years. It's possible, right? But most of the time, the characteristics of most major currency pairs are sideways price action. Here's a look at the euro versus the British pound. What do you see here? This is going from 2014 all the way to 2025. And this currency pair, while it's had big moves down, big moves up, and lots of in-between motion, it has mostly moved sideways. It does not trend on a long-term consistent basis in a particular direction. That is why we call currencies unbound. Here's the Canadian dollar against the Japanese yen. Again, two major currencies, and this is 2005 to 2025, and this thing has moved nowhere, sideways. It's trading at a similar level right now as it did before the great financial crisis in 2007. Now, are there massive moves in currencies in one direction? Sure, that does occur. And the idea that we want to get into with this video is that we mostly know that currencies do have these ginormous moves, but over the longer term, especially when you pick the correct currency pair, they relatively operate in a range. So why do currencies behave this way? Why is it that stocks and commodities and things like that tend to rise over time, or volatility, the VIX, tends to fall over time, but currencies tend to just range bound over the long term? Why is that? Well, let's think about what currencies actually are. Currencies reflect two economies. Major economies ebb and flow. They have good cycles, they have bad cycles, things are going well, something in the world changes, the price of oil goes up and that impacts Canada, right? There's real world stuff happening. There's business cycles, there's global events that occur like wars and, massive secular shifts in thinking, supply shocks, all of this stuff is happening. And when we talk about two currencies, as opposed to a currency as opposed to an asset, which typically rises in value over time, like think real estate or gold or stocks, these things should rise in value over time as they grow and continue to add cash flow. But when we're talking about two currencies, when we're talking about, the economy one and economy two, we have to think two major economies are both growing at the same time. And so the relative performance of the two should kind of look like this. There's times where one is growing faster. There's times where the other is growing faster. Remember, if economy one is growing and economy two is growing as well, and we're comparing the two economies in the form of the currency pair between them, the relative strength of one over the other is actually usually going to move like this if they are both major Western economies growing at the same time. So in today's world, Western economies are highly correlated, especially due to globalization, right? We're all trading with one another, even though at the time of recording this, people are all uncertain about how trade will develop from here. But the point is, globalization has made it so that many economies around the world are very highly integrated with one another. While assets grow in value relative to fiat currency, major currencies relative to each other usually tend to mean revert back and forth. So remember at the beginning of this, I talked about direction is going to be very important for this strategy. And in this concept, we're going to be talking about strong versus weak currencies. We want to identify currencies that look like they are likely to outpace other currencies in the here and now versus currencies that are more likely to devalue or weaken against their peers. Economies drive a currency higher or lower. At the end of the day, economies, economics, macro, geopolitical stuff, that is what causes the euro to rise or to fall. That is what causes the US dollar to strengthen or weaken against its peers. The real movement in the market, the underlying drivers are the macro, the economies of the world. That is why there is a massive profession called economics. It's people studying the economies of the world. And that's why all of us, to some degree, whether we know it or not, are fundamental analysis traders first and foremost. Remember when you go to the gas station and you're like, whoa, that price is higher than usual? That's fundamental analysis. When you go to the grocery store and the prices are, going up, that's fundamental analysis. Recognizing that you are having an easier or harder time getting a job currently, that's fundamental analysis. If people are hiring, if businesses are doing well, that's fundamental analysis. All of us, whether we trade or not, are impacted by the real forces of the world, which is fundamental macroeconomic analysis, right? That's what we're doing here. So that is why it is a critical component to this trading strategy. And I know it sounds complex and scary, but it can be made simplified, and I'll talk about that in just a second. Just a quick pause. I have a full course and playlist available for free on my channel when it comes to fundamental analysis. Maybe we can pin that in the top right hand of the screen here so that you can check that out on your own time. You can save that. You can always go to my playlist section on my YouTube channel and explore that at your own pace. But fundamental analysis do play a component here. The main idea is that I focus on economic growth, jobs reports, inflation, and monetary policy because these are the driving forces of currencies, commodities, indices, and pretty much everything else in markets. I map out the economies that are outperforming versus the ones that are underperforming expectations. And I use software to automate this process so that you don't have to have a PhD in economics to understand this. And I don't have a PhD in economics. I actually went to school for software engineering. So instead of learning, how to do all of this economics all the time in my head, I've built software to help automate this process. Specifically, I like taking a look at the economic surprise meter that I'm going to show you now. So what we're looking at right now is called the Edge Finder. It's a software tool that I have built with my team in order to basically track a bunch of macroeconomic data and to help me find strong versus weak currencies. Specifically, we're looking at the economic surprise meter. And when we look at this, what we see here is that we have currencies that are getting higher or lower scores. Essentially, we've automated this to tell us which currencies are significantly outperforming expectations currently or missing expectations recently. So when I look at this, right, quick way to read this is New Zealand, the UK. These ones are having strong outperformance relative to their expectations, which I'll discuss in more detail in a second, versus Japan or the US, which is actually having some lower than expected economic reads recently. You can go into more detail. So we could see, let's take New Zealand, for example. We're looking at all these key economic metrics like the growth of an economy, PMIs, right, which are forward-looking indicators of an economy, retail sales, which is the state of the consumer, inflation reports, unemployment rate, unemployment change, right? So all of these variables are important things. And what I'm looking for is a strong economic outperformance. So like for a quick example, GDP growth in New Zealand was forecasted to be 0.4%. It actually came in at 0.7%. That is obviously better than expected. And so we get a bullish impact on the New Zealand dollar in our system here. So we can see overall, when we summarize all this, we're getting a pretty strong outperformance report here for New Zealand. And then we go back, like I said, to originally the economic surprise meter here, and we can see that New Zealand is getting a very strong score. So this helps me to automate the process. Feel free to pause and read about this on the screen here. Maybe we can zoom in on this in the edit, but basically, a higher score indicates that the majority of key economic metrics like GDP, PMIs, CPI have recently been strong relative to economic forecasts, and a lower score indicates that the majority of key economic metrics have recently missed their expectations relative to economic forecasts. Here's the US economic heat map, and while I know that this could be a little bit overbearing, this is a lot of stuff all at once, I have actually put together a full playlist for studying all of these different individual metrics, everything from GDP growth to PMIs. And if you'd like to explore that, we'll link it in the top right hand of the screen right now, or you can find it in the description down below. Also, if you are interested in getting access to a copy of this software that we've built and maintained here at my company, A1 Trading, there will be a link and promo code in the description down below if you'd like to purchase a copy. That promo code and link will get you a very nice discount on the product, and you can use this yourself to regularly keep an eye on the strength or weakness of various currencies. Now, without going too much further in detail on the Edge Finder at this time, let's jump into an example of how I might use this strategy. First, we'll take a look at dollar yen, which is getting a bullish reading within the Edge Finder, meaning that after looking at sentiment reports, technical reports, and economic data, we see a strong overall bias towards bullishness for the dollar yen. Looking at dollar yen on a technical chart, what gets interesting here is that we've been in a downtrend and we've recently kind of broke momentum to the upside. So I actually added a long position at this time here recently, basically with the idea that I think that the fundamental overall direction is starting to flip bullish. I also like the technicals after breaking out here, and I've decided to go long at this level. Now, when I talk about dollar cost averaging or mean reverting, I think that on a longer term basis, the dollar yen has hit a very long-term level of support here. It looks very good, in my opinion, on a long-term chart after finding support and moving higher. So the second part to this, however, is I may actually choose to add in a second, third, or even fourth and fifth trade on this dollar yen. Now, I took a very small initial trade here. My idea here is that I think that we at least should make a move back up to 151, but I don't know the exact path that we're going to take to get there. I don't know if we're going to shoot straight up to that point in which I can simply take a profit. I don't know if we're going to oscillate around before making a move here. I don't know if we are going to actually test some lower levels of support before ultimately going there. And I also don't know if we are even going to break lower. But the beauty of this trading strategy is I don't necessarily have to know which path. I just have to generally get the direction right. If we move higher, I can make money, whether it means going down first or going up right away. I can make money with this strategy because what I'll look to do here with dollar yen is, let's say we have our initial long here, but we may want to add at this level and at this level. So on a daily chart, this is a longer term focus, right? We may come down and test this area, and then maybe we shoot up to that level of resistance. And I would get one and then a second trade entry, each of very small size, to where I could close out for a profit here and move on and repeat the process. As long as we have a strong currency versus a weak one, I can set up this trade and continue to hold it until we get to a point where I can either take profits or decide to close down the operation. And of course, we could see a situation where I take the first trade, see the second trade, and then ultimately take a third trade, right? And then maybe we move higher from there, right? So what this does is it removes the pressure of I need to be right here with a tight stop loss, and instead says, okay, I can take an entry here, very small size. I could take an entry here, very small size, an entry here, very small size. And if all of that moves against me and something changes in the fundamentals drastically, maybe I choose to just close down the trade for a loss. Or what I could even do is, let's say it's all moved against me, but my position sizing is so small that it's not doing any sort of considerable damage to my account. And instead, I look for an opportunity where price retests and I just close everything for a much lesser loss. The beauty of having such small size is that I'm not pressured or feel the stress of needing to be right so quickly. And instead, I can simply enter at levels that I like with an overall direction, and as long as my fundamental analysis is still overall correct, I could still make money on the trade, or at the very least, control my risk by closing at a good level of resistance, right? I'm not forced to close out at peak maximum loss because my position sizing is so small that I can handle the situation. So again, let's recap what we've done so far. We've identified the fundamental analysis here using software and using our understanding of fundamentals to get an idea that I think overall the direction for the dollar yen is higher. However, I've also noticed that with the technical analysis component of this, I don't have to be so worried about timing this thing perfectly. I can take an entry here, I can take an entry here, I can take an entry here. And with such small risk management, right, with such small size, I am not pressured to be correct in the short term about this trade. In fact, I'm happy to hold and wait patiently for the market to make a move that I think it ultimately will. And if it doesn't, I will manage the trade correctly and adapt to what I'm sitting in, right? I'm dealing with the trade, dealing with drawdown. People are so afraid of drawdown, where I actually think that some of the best, traders are just very good at dealing with, handling, and moving through a drawdown. That is really, truly the core to this trading strategy. So as I showed you in that visual example, let's talk a little bit about position sizing. So instead of a full size position with a very tight stop loss, I may actually split my entries into 3 to 5 levels, and maybe even more, but I'll talk about that based on a basket in just a second, a basket approach. Each entry is very small in size, allowing me to scale in and improve my cost basis without worrying so much about timing the market perfectly, which is, by the way, hard for everyone. The goal is to accumulate long or short positions in a gradual fashion and then offload positioning when price moves in my favor. And the backup plan, which is important, is knowing what your max drawdown on the trade should be and reevaluating the fundamentals regularly to determine if you should still be in the trade. If something drastically changes, I will look for an opportunity to exit the position. Here's a quick example of a euro pound idea that I recently had. I entered a trade, it moved further against me, but my size was so small that this didn't even matter, right? It was so small, not even a worry at all. Second position, and ultimately was able to close out that trade when it moved back to the moving average here that you see. So I can already hear some of the criticisms of this approach. And by the way, you can criticize any approach in the trading world. So, you have to have your prepped answers in response to how you can handle things like this. So this is where people go wrong with a strategy like this. A lot of people say this sounds incredibly risky. You're just martingaling. You're going all in. Well, first of all, let me address the martingale accusation. Martingale is where you take a bet on let's say you're long. You buy one lot, and then you do 2 lots, and then you do 4 lots, and then you do 8 lots, and you do 16, and then 32, 64. You get the point. I don't double my positions. So when I take a trade, I'm usually taking uniform sized trades. So let's say as small as a 0.01 lot size, right? And then I may take 5 of those, right? 5 times on a particular currency pair. I'll take the 0.01 lot size, right? It's very tiny, but it gives me so much room to just test the waters, try the trade out. I don't need to freak out about my timing. I can just get involved with an idea and I can build into a position. So I could go as much as 10 times at this and still only be in a 0.10 lot size position. Very tiny trades, right? But I can take many of these. And I'm not worried about timing when I'm using such small size, because I'm not going to blow my account with a 0.01 lot size unless I really seriously add like hundreds of those and get crazy with it. So my point is, this, if done correctly, or done inappropriately, can be a disaster, right? People martingale, people take huge positions and they hope and pray that the market ultimately goes in their favor. That is not what we're doing here. What we're doing here is we're talking about scaling into trades and looking for an ultimate move, just not so worried about timing. In exchange for not having, the picture perfect trade where we get long here with a stop and then we just rip higher, which I do some of that. I'm not saying I don't do that or I don't believe that that's ever appropriate. I just, for FX specifically, much prefer the dollar cost averaging approach, because timing of currencies is very difficult. They're very choppy instruments by their very nature. Over the long term, they tend to range bound. So I believe an entry style that is more or less focused on timing is more favorable in Forex for me specifically. Again, each trader has their own strategy, but this is what I do. In this strategy, I am highlighting the idea of gradually scaling into an idea that I have, but still acknowledging what we'll do if we're wrong, right? We're not just saying, oh, I'm all in and this has to go up in the next 30 days or my account is going to blow up. That is absolutely not what we're doing. Again, that's taking this strategy and making it an inappropriate approach. If you're risking heavy, if you're going all in, if you're concerned about your trades at all, your size is way too big, right? The way I do this is so boring, so small, that it would take the world falling apart for my account to blow up, right? The size is so tiny, and the returns, you might say, well, then they're going to be small returns. Yep, that's the reality, right? I go for small, consistent gains, and I stack the account over time. I'm not worried about making a ton of money quickly. And that's where people go wrong. They want to make their account grow really quickly, and that's not this strategy. If you want to grow your account quickly, I don't really know how to do that consistently. I know how to consistently grow accounts slowly, but I don't know how to do that consistently quickly. And to me, that's the secret of trading, is go slow and you'll actually survive, go fast and you'll blow up. The beauty of dollar cost averaging is that there's no pressure of getting entries perfect unless you're over leveraged, in which case you've done the inappropriate act of going way too heavy. If you are worried about being right in the short term, that is, again, short-term thinking, and in trading, that is really dangerous because you're more likely to blow up. So let's talk about trade disqualifications and max drawdowns. So max drawdown on a total portfolio should be considered here. So whether that is 10% if you're very low risk tolerance, 20% if you're kind of moderate, 40% if you're decently aggressive, and 50% plus. If that is your max drawdown, that's where you close everything down. You have to ask yourself, this is a personal thing to choose, right? This is personal preference, depending on your position sizing and risk tolerance. That's going to heavily determine all this. So if fundamentals drastically change, an exit strategy should also be formed. I do have a playlist, by the way, on risk management, and there are many ways to manage risk beyond just having a technical, stop order in the markets, right? There are many ways to manage risk: diversification, having a max drawdown, spreading your bets, dollar cost averaging with small enough size. There are many ways to manage risk beyond just a stop loss. A stop loss is a very popular way to do it, but it's not the only way. And I do use stop losses on my other main trading strategy. However, for this particular strategy, I don't need the stop loss, right? Stop loss doesn't matter so much because my sizing is so tiny and I'm scaling in and scaling out and still acknowledging where a trade has gone wrong and closing it out. What you're looking at, by the way, is an extension zones tool. I know I've shown this a couple times in the video. All it basically does is it uses a couple Bollinger Bands and creates some zones here. This indicator is something that we've built on our website, a1trading.com. I'll leave a link in the description down below to where you can pick up a copy of this indicator. It is also available for TradingView, MT4, and MT5. We've built it for all platforms there. And I use this indicator to help me spot opportunities where the market is starting to become overextended. But just an emphasis on what we talked about already, I'm only really interested in these kind of signals if the fundamentals really line up with this technical entry pattern. So next up, I want to talk about another concept or another risk management concept, which is spreading bets. Spreading my bets across a basket of currency pairs if I specifically have a strong bias in a particular currency. So let's just say, for example, that I think that the dollar is likely to go bullish, right? I'm bullish on the dollar, let's just say. If that is the case, what I may choose to do is instead of just going, all in on a short or isolate the trade into just shorting the euro and buying the dollar, instead of just doing that, what I could do instead is build a basket. What I mean by that is, let's say I'm long dollar yen with small size, but I'm also long dollar Swiss, and I'm also short euro dollar, and I'm also short the Australian dollar against the US dollar. In all of these cases, I'm actually just long the dollar, but spreading it out through many different currency crosses. That's something that I think is really another way to just diversify, because what if, for example, the Japanese yen has a crazy move? That would really, if my whole trade is built around just dollar yen, that could really kind of offload what was my idea specifically on the dollar. So if I want to rule out any, huge moves on a particular currency, what I can do is actually spread my bet and be long the dollar against many other currencies, each with very small position size, but still bullish the US dollar. So I also wanted to make a quick note to something that I've done, which is also semi-automating this whole process. So I mentioned that I've done, the automation with the fundamental analysis component, but also the technical component. I have built some pretty cool stuff with a trading robot that helps to partially automate this process. The technical analysis component is 100% automated. It is a full strategy and uses that indicator that we just got done showing a couple screens back, right? So if I go back here, it basically will short this area, cover here, buy here, look to cover back here, right? It's an automated technical component to this trading strategy. So if you're interested in that, we'll leave that linked in the description and maybe put a card in the top right-hand side on the EZ robot. It's the extension zones robot, and it is a tool that we've been working on here behind the scenes to just automate the technical component. It is by no means a set and forget easy riches robot. That's not what I'm trying to promote whatsoever. It's just a tool that I use to help automate this process and to monitor my positions and close them out if things hit certain criteria. So I'm not going to go too much in detail in this video on that, but I do have a video on the subject and it can be found linked in the description below. Side note, I also do this in stocks and options, but it is a slightly different variation. In the stocks and options world, I use a mean reversion strategy called the wheel strategy. You may have heard of this before, but it basically profits from selling options. Instead of buying calls and puts, it sells options for premium. It's highly consistent and has many similarities to what we're talking about here with the dollar cost averaging strategy in Forex. The video card above has the link. I'll also link in the description. Just a quick reminder, this is what works for me. Every strategy has pros and cons. You can make anything in the markets, any trading strategy look foolish at times, but this is what I'm comfortable doing and may not be right for you. So this video, the goal of this video is to give you an example, and I also have other Forex strategy videos that you may actually resonate more with if this one wasn't particularly your favorite. I have a full video playlist that will play here on the screen right now.